When physics and advanced mathematics entered the trading floor, the very nature of risk management was transformed forever. Before exploring volatility models, we must define the fundamental mechanic of the trade and arbitrage opportunity. It is the search for discrepancies where the market price deviates from statistical reality.
An arbitrage opportunity is essentially when you can make a couple trades simultaneously to get away with a risk-free profit in some way or another. Essentially, there's an inefficiency in the market for whatever reason, and you trade that inefficiency such that you can make a profit. In this particular case, what I mean by statistical arbitrage is exploiting an inefficiency that we've found due to some sort of statistical analysis, right? So instead of having the world be some way and have...
Arbitrage is essentially a hunt for market inefficiencies where a statistical model proves that the world isn't quite where it should be. Modern quant funds maintain their competitive advantage through sheer processing speed and exclusive access to granular market data. They operate in a time frame that is completely invisible to the average retail investor.
Have techniques that have been honed over a long period of time, and they also have, in many cases, access to markets that other people don't have. For instance, they can trade in microseconds, and so they can trade faster than normal people can trade. They also have algorithms which show them how to shop.
When you can trade in microseconds, you aren't just following the market, you're e-shopping for the most efficient price points before anyone else reacts. Long before high-frequency algorithms existed, the concept of a call option was used strategically to corner the market on ancient Greek call-off presses.
Known options were bought around 600 BC by the Greek philosopher Thales of Miletus. He believed that the coming summer would yield a bumper crop of olives. To make money off this idea, he could have purchased olive presses, which, if he were right, would be in great demand. But he didn't have enough money to buy the machines. So instead, he went to all the existing olive press owners and paid them a little bit of money to secure the option to rent their presses in the summer for a specified price. When the harvest came,
this ancient call option proved that identifying future demand doesn't require owning the physical asset, only the right to rent it. At its core, every volatility strategy relies on a derivative, a financial instrument, whose entire value is tethered to the performance of an underlying asset.
A financial instrument whose value is derived by its underlying asset. And there are different types of financial instruments which are deal into the markets, like stocks, bonds, commodities and currencies, and the market index as well. So these are the types of derivatives which are traded into the market, and this is the meaning of the derivatives.
Okay, anyone else? Okay, so here is one thing. If I feel that the answer is not sufficient, I'll ask other person, okay? Yeah, anyone else?
Whether it's a stock, a bond, or a commodity, the derivative acts as the mathematical shadow of the underlying price action. Modern quant platforms are democratizing these models, allowing users to develop instructions that execute precisely within a finite time frame.
Democratizing quantitative finance in some way or another. The key assumption there being that quantitative finance needs in some way to be democratized. So what we mostly do is we host a bunch of free open source tools so that people can research and develop algorithmic trading strategies. And what I mean when I say an algorithmic trading strategy is just any sort of instructions that terminates in finite time specifically for the purpose of trading, right? The most basic trading algorithm could just be buy Apple.
A trading algorithm doesn't have to be complex to be effective. It just needs a clear, data-driven set of rules to follow. While stock prices appear chaotic when graphed over time, mathematicians find tradable signals by analyzing the variances between daily closing points.
That. So we get now is something that looks like it's vibrates or varies along a line which looks pretty much to be 0. So it looks pretty much like it's it just oscillates around this line. Sometimes there are big big spikes up or big spikes down, but basically it comes back to.
By stripping away the price level and focusing on the vibration, we start to see the random walk that Bachelier first identified over a century ago. Many portfolio theories fail because they rely on the assumption that markets follow a smooth, normal Gaussian distribution.
Believes modern portfolio theory assumes that markets are normal, or that if you make the price distribution, it looks like a Gaussian curve. Imagine here in the middle between you and I, a Gaussian curve with two sigmas, and then let's say this side would be the fat tail, and this would be the exuberant side of the equation. And in between, normality. So normality, when modern portfolio theory, the tenets of modern portfolio theory and Black-Scholes and everything works, is when you're kind of inside those.
The real danger lies in the fat tails, those extreme events where the standard math breaks down and everyone suffers simultaneously. The objective is to distribute capital across numerous biased assets to maintain high returns while significantly reducing individual risk exposure.
Modern portfolio theory is a very simple idea. I'll go through it very quickly. If you put all your money in one investment, it may have a great expected return, but there's a lot of risk. However, if you spread your money around amongst lots of investments, you may still get the same expected return, but with less risk. Think in terms of, you've got a coin, it's biased, it's 55% chance of getting heads. If you put all your money on that one coin, then you may double your money, but equally.
This is the foundation of the Sharpe ratio, maximizing your expected return relative to the amount of volatility you're willing to stomach. Top-tier firms employ massive teams of judges to manage global market modeling, specifically searching for natural probabilities within the data.
Market modeling team at Morgan Stanley. It's a group of about 70 PhDs mostly spread around the world. There's about 30 of us in New York, some in London, quite a few in Budapest, and a few in Beijing. The title of this talk is Can We Recover? And it's meant as a triple entendre. So it could refer to either the systemic risk arising from the credit crisis, or
they are essentially trying to reverse engineer what the market believes the future probabilities of a stock index will be based on current derivative prices. No single anomaly is sufficient for immense profit instead. The strategy focuses on stacking subtle, predictive patterns identified through machine learning.
To be subtle things. And you put together a collection of these subtle anomalies, and you begin to get something that will predict pretty well.
How elaborate are these things? Because in my head, I'm imagining, some equation like Pythagoras equation. You put a few numbers in and something spits out. But are these giant beasts of equations and algorithms, or are they simple things?
Well, the system, as it is today, is extraordinarily elaborate.
By stacking these tiny, subtle anomalies together, you build a system that can finally start to predict short-term price movements accurately. Professionals utilize technical metrics like long convexity skew, which serve as the structural backbone for sophisticated volatility hedges.
And now Kai is specialties in volatility arbitrage. So we're going to talk all things long convexity, long skew, and long vega. Don't worry, we'll also explain what those means. And for you diehards out there, we're definitely going to talk about Gary, Vanna, and Charm as well. But we tend to have a little bit of background to our investors and maybe the first seat or desk they worked in at maybe an institutional trading desk. But I want to start a little bit earlier with Jem. So let's actually start with Jem Carson. What kind of name is Jem, and how do you pronounce?
Understanding supply and demand in these complex systems is what separates a true volatility trader from a simple speculator. Quantitative analysis requires the objective discipline of quantifying every idea, moving away from subjective biases that plague traditional trading.
Quant is not like AI or machine learning or all these fancy words that people talk about. It's really just putting numbers to your idea, right? It's trying to be a little bit more objective and less subjective. And I think every good trader kind of finds their way towards quantitative finance. just because it's really hard to make money subjectively.
And when you talk about that, me and you have had conversations on sort of technical analysis, and
it is incredibly difficult to make money subjectively. Moving toward evidence-based analysis is how you avoid the faith-based trading traps. Pairs trading involves identifying to assets that oscillate around the stationary mean, allowing traders to profit from mean reversion.
Pairs trading is to try to find stocks, a pair of stocks, where a certain portfolio of these two stocks have the same property, namely that the price of this portfolio oscillates around a fixed value. And once we have such a pair, then we can trade that portfolio the same way I described before. If the price of the portfolio is way above zero, we can...
If the relationship is linear, you can short when the pair is above its mean and go long when it's below, capturing profit as it reverts. In markets like coffee or sugar, many traders focus only on the front month, failing to notice the correlations between complex spreads.
The correlations I started to see. I started trading in 1991 and started developing a trading system programs based on the different correlations in the spread trading that I noticed at the time. Over the years, I lived through many multi-year cycles and developed my trading model based on the information that I saw. My data for my career is not back tested. It's something that I've lived and have actually traded.
When you live through multi-year cycles, you start to see data that isn't just back tested, it's lived. This experience creates a unique, uncorrelated model. In merger arbitrage, the paramount strategy is avoiding deal breaks, as a single failure can quickly negate the gains of numerous successful trades.
Style is quite simple actually. We invest exclusively in very safe transaction. The most important part in merger arb is to avoid deal breaks. Basically, when you have a deal break, it takes you 10 deals to make it back. We try to avoid deal breaks, and by investing only in very safe deals and late-stage transactions. This is the most important part. We invest only into definitive merger agreement transactions, friendly deals.
By being highly selective and only entering safe or late-stage transactions, you calibrate your position based on timing on legal completion. Retail investors often possess an edge over Wall Street by observing real-time shifts in consumer behavior before they reach institutional data.
Everything that I do revolves around one principle, and it's trying to surface change early, right? And so that sounds like the easiest thing in the world because it's something that anybody can do. We observe change in the world around us, in our physical world, digital world. So there's nothing necessarily that I can do that you can't do or anyone can do, but it's like having to retrain your mind to observe more keenly than you normally would. And
Wall Street is prone to groupthink. If you can detect a shift in culture via social sentiment faster than they can, you've found the ultimate edge. Many quants transition from fields like software engineering, applying their technical rigor to financial markets to build additional income streams.
It was easy money because everybody was in the market and it just crashed. Everything was going up. Literally could buy calls. You were a genius. I think I made $20,000 with $6,000 my first month. And it wasn't because I was a genius. It was just because everything went up. So if you bought calls, you made money. I mean, I remember one night, I was holding $1,400 worth of Boeing. Mm-hmm. This was when it rose from 150 to 200 in a week.
In an easy money market, everyone feels like a genius. But the real test is whether your code can replicate results when the data turns crap. The Kelly criterion is a mathematical formula used by professionals to determine the optimal fraction of wealth to wager on any given trade.
Amongst finance professionals, but it's even easier than modern portfolio theory. It says if you invest a certain fraction of your money on some risky bet. It's got a positive return, but some risk. It tells you how much you should invest, what fraction you should invest if you want to maximize your expected return. The maths is absolutely trivial. The fun thing is this, that
if you bet too much on a biased coin, your expected return actually becomes negative. It's counterintuitive, but the math doesn't lie. Bond markets offer predictable excess returns, with data showing strong statistical links between returns and the yield curve structure.
Returns really are predictable, and they're predictable with fairly high R-squareds, and there are a lot of reasons they're predictable. They're related to a lot of information that we collect out there, including a lot of macro information. But almost all of that evidence is constructed by running regressions, full sample regressions. We take a realized excess return, a set of potential explanatory variables, we project it full sample, we see we have R-squared 20, 30, 40, 50%.
However, the naive learning of a rolling regression can vary wildly from full sample history, meaning the convergence of these models is often slow. Just as in martial arts, confidence in a financial position can be misplaced. Knowing when to exit a failing trade is a vital skill.
First thing, it's going to humble you, right? Like, I can't tell you how many times where, like when I first got started with jiu-jitsu, I'd say I'm in like year 6 or 7 now. Right? When I first got started with jiu-jitsu, I was athletic in terms of, I could bench, I lift weights, I could deadlift, squat. Like I was fairly active in the gym, and I was boxing before jiu-jitsu. So,
a stubborn trader who refuses to accept they are wrong eventually runs into a heel-hook market event that dismantles their entire capital. Many volatility advisors leverage engineering backgrounds, viewing market structures with the same precision used in large-scale structural projects.
Financial mathematics, along with policy, was always kind of on the edge of, debating whether to go do School of Foreign Service, right? Kind of study broad macro policy, or really go to the math quantitative side, which was always my other leaning, coming kind of from my structural engineer father. So, and I found the perfect mix of both worlds, ultimately, which is,
This TradFi disruptor background allows quants to bridge the gap between abstract policy and applied quantitative arbitrage. While small trades go unnoticed, executing large-scale orders can significantly distort market prices and erode the profitability of a quant model.
Price history data. For one thing, commodities especially used to trend, not dramatically trend, but trend. So if you could get the trend right, you'd bet on the trend, and you'd make money more often than you wouldn't, whether it was going down or going up. That was an anomaly in the data, but gradually we found more and more and more and more anomalies. None of them is so overwhelming that you're going to clean up on a particular.
If you don't understand the costs of your own execution, you can push the market so far that your entire model becomes unprofitable. Quants must distinguish between forwards and futures, as futures are traded on exchanges, which substantially reduces counterparty risk.
About this is forwards are customizable contracts, futures are standardized contracts. Forwards are traded over the counter, futures are traded at the exchange. Forwards are highly illiquid instruments. Futures on the other side are highly liquid instruments. Forwards are only settled at the maturity. Futures on the other hand are settled every day, so that's why they are called mark-to-market instruments also. Now one more thing is there is no central counterparty in the, or you can say there is.
In the over-the-counter market, there's no clearinghouse. For the quantitative trader, liquidity and the central counterparty are mandatory. Quantitative traders utilize 3 specific probability measures to distinguish between physical reality, market pricing, and recovered beliefs.
There'll be 3 probability measures that we can be thinking about, and we'll call them P, Q, and R.
and I'd like to tell you what each of them means. So P stands for physical probability measure, so the P is for physical. And think of that as the actual objective reality of future states for, say, S&P 500. So
Understanding the difference between how fast prices actually grow versus how they grow under the risk-neutral tool is where the math shines. Traditional diversification breaks down when correlations approach one, making deep analysis of security interrelations essential for success.
Securities, and we can go very deep into the capital structures and understand what are the healthy parts of them and pair them versus the unhealthy parts of other securities and make very, very interesting sets of returns.
Your fund has really performed and a lot of other funds didn't, right? I understand you made money in 2008, you made money in 2009, 2010, 2011, and in 2012, right? So tell us more about how do you produce your returns?
Sometimes a perverse market dislocation forces pricing relationships to become extremely attractive for quants who understand the underlying risk. Soft commodities like coffee and sugar are favored by institutions for their lack of correlation with the broader macroeconomic environment.
Spread strategy that I've been trading for the past 20 years, and it works. I mean, not a lot of people can say that. Like the data I've traded, the things that I do, are not things that I back tested. I've lived them. I've traded this stuff because of the nicheness of it, because of the quality of the infrastructure that I'm building. We're starting to attract a lot of institutional investors. In fact, we're currently undergoing due diligence by 3 large institutions, one in California.
These crops are still grown on hillsides and harvested by hand, just as they were 150 years ago. That inherent manual volatility is a goldmine for quants. Investing in speculative transactions is inherently dangerous when a definitive contract is absent, allowing parties to withdraw on unexpected news.
Milan acquiring Perigo, it was a hostile transaction, which was obviously not recommended by the board of Perigo. The threshold was quite low at 50%. Having said that, it was still a speculative deal, and we decided not to enter into this transaction. We only do friendly transactions, which are recommended by both the board of directors and the key shareholders. Otherwise, we would not invest in the deal. Another example, for instance, is the Zurich and
Avoiding deal breaks means only investing when both boards of directors and key shareholders have given their recommended approval. By analyzing global social media sentiment, quantitative researchers can convert subjective human passion into a structured investment process.
You can read the minds of every person in the world by simply knowing what to look for through social media sites, like comment analysis. You know, I spend 3-4 plus hours a night just reading comments, mostly on TikTok. Like, yeah, so let's hope TikTok doesn't go away this weekend.
Yeah.
And it's because that's where people express themselves. That's where people talk most openly about the things that they're passionate about what they're buying, about what they want.
People talk most openly where they are passionate. If you can read that sentiment accurately, you can surface changes before they hit the charts. Many quants encounter difficulties when first applying models to real-world data, which often contains noise and deceptive signals.
And our initial results seemed good. We actually saw patterns and we signed up because, remember, we're broke, like 20-something-year-olds. We don't have option metric status. We signed up for this service called OmniQ, which was run by some guy who basically abandoned it. And it was like $40 a month for historical option data. And when we used it, it was like, holy shit, with this, it's 70% of the time it predicts earnings. That's amazing, right? And
the transition from a software engineer to a quant involves a trial by fire where you learn that even the best models need high-quality data. Humility isn't a virtue, it's a risk management requirement.